A happy morning to all of you. This is Magdalene from Itus Capital, and I'm glad to welcome you all to our 3Q Investor Call 2024. Thank you all for taking the time to be a part of our Saturday call. At this time, all the participants will be in listen-only mode, and after a brief presentation by our founder and fund manager, Naveen Chandramohan, we will have the Q&A session. Today, Naveen would walk us through on our portfolio performance in the last quarter and discuss his views on the market. Let's hear from him. Over to you, Naveen.
Thank you, Magdalene, and thank you for everyone who've joined on a Saturday morning. Wishing you all a wonderful, happy Vijayadashmi. Today, we'll take you through the September 3Q update from Itus. First, in terms of how I would like to structure the call, we'll be walking you through the performance of the portfolio. We'll then take you through how our portfolio is positioning and the thought process behind it. And the next section, I'd like to talk to you about how do we see what the market is. The market to us is constituted of three variables that constitute what we call as the price, composed of earnings, liquidity, and valuations. So we'll address each one of them around what we see today. And finally, take you through the themes and trends that we see on the ground, basis which explaining how we are positioned. First, the easy bit, talking about the performance of our portfolio. The fund returns have been consistent over time. So 1 CR invested in the fund starting at the inception in 2017 would be roughly worth 4.65 CR today, post fees and expenses. This comes to a CAGR of 22.1% post net of all fees and expenses in terms of investor returns, beating the market and our benchmark by close to 4.5% IRR over the last 7.75 years. What the next slide shows is the breakdown of our returns on a year-on-year basis. Here again, the fund has shown consistency, barring 2 years in 22 and 18. Every year has seen the fund outperforming the benchmark. Even calendar year 24, our performance has been beating the benchmark by around 4% net of fees and expenses. As we speak today, the fund is aligned more so from a large cap perspective when we break down our market cap skew. And that's a conscious decision in terms of how we want to position for liquidity. If I measure the weighted average market cap of our portfolio, that stands at 3.05 lakh crores, which is what I spoke to you about, aligning more so towards a large cap. Now, large cap by its very definition, in any benchmark is skewed towards banking and financials, which is where we are underweight. So one of the themes that I want to express is the fact that a large cap does not mean a banking heavy portfolio. Quite to the contrary, at ours, we have an exposure which is overweight pharma, consumer staples, non-lending financials. So it's not like we don't have a financials exposure. It's just that our exposure where we see growth and margin accretion is more so coming from the non-lending financials bucket of the portfolio. And finally, the power and gas. Where we are underweight is where the index is aggressively represented in terms of the weights, which is banking and technology. So here again, a large cap does not mean positioning ourselves where the index is. So moving on.
So if you look at our positioning, like I spoke about, we are deployed with a roughly 7% cash balance. This is weighted average across all portfolios. But then when you go and break it down further, clients that have come in recently would have approximately 22 to 23% still undeployed capital, which we would deploy over the course of the next 3 to 4 months in an environment if we have slightly more increased volatility, which we anticipate going in towards year end. Now, moving on in terms of, while I spoke about the macro construct of the portfolio, we'll go into the dynamics of one of the levers of how we think about the market, which is from the view of earnings. Now, any market valuation that you give, according to us, comes from what we call as rate of change of ROE. You can call it as rate of change of earnings, but the issue with just using earnings is an earnings growth does not mean it has to accrete to ROE growth. because ROE has an element of a certain element of capital allocation from the business that's important to study. And hence, when an earnings growth translates into an ROE expansion, that results in a business giving you structural IRR. Now, if you look at the history of large caps in India over the last 15 to 80 plus years, what you would see is over the last 4 years, where India has gone through what I would call as a structural bull market, you would see a growth of ROE expanding over time. And there are two ways to look at this number. In the previous bull market, where people obviously look at history in terms of studying markets, the ROE back in the day, in the previous bull market, was a lot higher than today. Do I think that we can go into those ROEs? It's going to be a lot harder because as the base effect goes higher, it also means from a percentage perspective, your growth will normalize. But can the ROE expand from here? It certainly has room to expand from here. So end of the day, what you are seeing in terms of growth has come through because of ROE expansion. Now, if this growth in terms of IRR comes only because of PE re-rating, that's where you can call the market expensive or cheap. So before we go into how we think about valuation, purely from an earnings perspective, just if you look at the trend of large caps, you would see a positive base effect accruing in terms of large caps over the last 4 years. One of the reasons India had a poor decade between 2010 to 2020 is where Nifty CAGR at 7.5% over close to 11 years is because of the structural decline in ROEs. So end of the day, from a longer term perspective, you want this number to go higher or stabilize at this range if you have to generate IRRs. Now, the same thing if you look at it from a mid-cap perspective, right? So again, you will see a very similar trend where mid-caps too have expanded their ROEs. However, the difference in this case is the multiple expansion that you have got has been roughly 1.5 times alongside the ROE growth. So in terms of expansion of actual valuations, mid-caps have given you much higher IRRs over the last 4 years for the incremental ROE that has accrued into this particular space. So end of the day, here again, I don't believe that you can go back to a 24 to 25% structural ROE that you saw back in 2007. But there is selective room for ROE expansion that again comes from bottom-up stock picking. But as a space, if you look at it, it certainly is not cheap. And finally, in terms of small cap. So while even if you look at the September flows from Amphi that was released, this flows into small caps continues to be extremely strong. But from a fundamental perspective, over the last 4 years, while ROE has expanded, the justification of PE re-rating has been a lot higher in this space. And if you think about it, the differential between what you saw in 2007 versus what you're seeing in 24 is not very high in this space. So while people can continue to drive momentum in this particular space, risk reward wise, you don't have a lot of room for ROE expansion from here. So here again, while one can be stocks selective in terms of how you want to position yourself, completely going overweight just because you're getting monthly returns is not prudent risk management. And I think studying this ROE profile of companies over time, because end of the day, some of the best companies, depending on the sector, will go through ROE mean reversion over time. So looking at a structural ROE expansion over 5-6 years without understanding history may not give you the right risk reward at any point of time. Now that we've just gone through the earnings lens in terms of why ROE matters, we'll just look at it from a liquidity perspective, right? So obviously, pretty much people are now very well aware that SIP in the markets is now structural. The trend is real. I still remember when we started the fund, the number was roughly around 4,500 crores per month. Today, that same number is crossing 23,000 crores per month. I'm talking about the gross number. The net number is a lot lower, but the gross number as we speak. And one of the things that I continue to maintain, I think FII into India, I don't think they are coming back in a hurry. I know it is counter consensus, but again, I don't see the need for them to come back to India aggressively. And Asia is transitioning into a space where domestics are going to control the flow of money. Because if you look at FIIs, considering the way US is performing, there is a lot of capital that is going back into the US. So MF as a percentage of FII AUM, I think this trend is only going to increase. And I don't think it's a bad sign per se, where domestics continue to have the lion's share of the overall market. But it also means that understanding the nature of the domestic investor becomes extremely important. Because it's not like an FII money is long-term, domestic money is short-term. I don't think that narrative is also right. But everyone is worried about FI outflows, and I think that is important to track because that has ramifications of which sectors money is going to get taken out of and which sectors money is getting invested in. So as we speak, counterintuitively, what I'm talking about from a risk management perspective is to be positioned in large caps and get underweight small caps. But if you look at the flow of money, it's the reverse. So why I am talking about the reverse is predominantly from a risk reward, looking into the future perspective. I don't think ROE expansion, assuming that it will continue into the small cap space, is a sensible thing across the board. Here again, if I look at it from translating the same number that was in chart, if you look at it from a financial year perspective, every year in the last 3 years, this is only the secondary market. So obviously people can break down data how they want basis convenience, but it's important to realize there are two trends of FPI flows. One is what you get from the secondary market and one is what you get from the primary market. The 1 year FII inflows was positive was FY 23-24. The reason it was positive, though I have shown a negative number, is that inflow went only into the primary markets. So FIIs are using positioning more so from a tactical primary market perspective, and structurally getting underweight, not underweight, but taking outflows from India. Whereas DIIs, if you look at it, that trend has been extremely strong. And I would not expect this trend to reverse anytime soon. Finally, in terms of the third lens that I was talking about, when growth is strong, like I said, 4 years, whether you look at large caps or mid caps or small caps, the top 500 companies have shown you structural ROE expansion. When ROE expands, you also don't expect the market to be cheap, which is what this particular chart says. So if you assume that rough mean P for what you call as the large cap market is roughly close to around 18, if you look at over a 22-year trend of India, you are at 1 standard deviation above mean. Mid and small caps are more like 2 to 2.2 standard deviations away from the mean. So from a relative risk reward perspective, while liquidity can drive additional deviation from the mean, you are getting into a territory where bottom-up stock picking and positioning in the right sectors becomes increasingly important from here. So while returns was the only thing that you looked at so far, I think risk-adjusted returns is going to become increasingly important from here. So 2 things that we are cognizant of. One, how do we not sacrifice liquidity? And rather than just saying that because market is a touch expensive away from the mean, so it has to correct. I'm not sure that's a wise thing to say either, because I don't think anyone can give you a timeline around when it has to correct. So 2 things that are going to determine this: the next few quarters, how earnings pan out, alongside next few quarters, how the liquidity in terms of the domestic market pans out. And this could induce some amount of volatility, though from a structural perspective, I think it is a long-term very bullish sign. From near-term perspective, positioning portfolios where you don't sacrifice liquidity becomes increasingly important. So if I was just to summarize our view on the markets, Over the last 3 years, returns in India, if you look at it from a top 500 companies market cap perspective, has been completely broad-based. I think from here, narrowness in terms of where your returns are going to come from, both from a stock picking perspective as well as a sector selection perspective, becomes very important. Mean reversion of ROEs already happened. Expansion of ROEs from here are going to be very, very bottom up from here. I don't think incremental liquidity in the short term is going to expand at the same rate, because one of the things that I'm talking about is you're also going to see in the next 3 to 4 months, the rate of primary issuance that are going to come out is going to be fairly high. So even if you assume domestic flows don't stop from the demand side, there is enough primary issuances from a supply side to more than absorb this. So positioning for liquidity in this kind of an environment becomes extremely important from here, rather than just measuring returns. Now, moving on to the next part of the conversation, where I was just going to cover some of the themes that we are bullish on and why. So again, power is an extremely cyclical sector, right? So you will see the last decade, most of the power companies between 10 and 21 destroying balance sheets and shareholder IRR. But over the last 3 years, not just in India, but globally, there has been a power capex supply deficit. And demand from a manufacturing perspective has been structural because of entire GDP expansion the world has seen. As a result of which, even if you look at India, if you just measure the capex from the top 6 power players, that's been on a structural uptrend. Now, the interesting thing about power is just because I set up capex doesn't mean that I can go live in the next 6 months. It takes roughly around 18 to 24 months for a lot of this capex to go live. So barring solar, a lot of this capex takes time to go live. And in the interim, the demand growth, especially for India, has CAGRed at around 8.9%, just slightly in line with our GDP expansion as well. Now, in line with this, you've also seen a structural transmission capacity increase, because whether I invest through thermal or I invest through solar or I'm going into nuclear, I still need my transmission capacity, which has been underserved, to increase. So both from a production as well as a transmission perspective, there are opportunities in this place, translating into what you call as substation capacity increasing. Now, someone who wants to steelman and play the other side will always say that because the industry is regulated, ROC expansion cannot become structural. There will be a cap on ROC. And hence, the valuation at which you play this industry becomes very important. Now, this, again, I don't think is just specific to India. This is a global phenomenon. If you look at, for example, what is happening from a global perspective, for the first time, tech companies are investing in power. It's an anomaly. It's something that you would never visualize. But if you believe in the trend of data centers, or if you believe in the trend of AI, all of this has power as its raw material. So in the US, for example, nuclear power plants have been shut down for almost more than 10 years. You've seen companies like Microsoft actually go and sign up and restart the 3 Mile Island, which was shut down more than 10 years ago. You've also seen companies like Amazon and Google commit to nuclear power, because not only is it clean, but it also gives you sustainability of power capex. So this is not an India-specific phenomenon. I think it is a global phenomenon, and this is a trend that we continue to see that could last 3 to 5 years. That's a space that we want to be positioning for. The second theme that we've covered in the past, just to reiterate this, since COVID, from 2019 onwards, one of the spaces that has gotten hit significantly in India is the average household income of the lower middle class not growing. And that, even if it grew at less than GDP, the package of where they spent changed significantly. So rather than spending in pure play FMCG, there was a lot of spending on what you call as mobile and data, etc. As a result of which the spending patterns changed. Hence, rural recovery that was expected took way longer than expected. Now, this last 2 to 3 quarters, were the first signs that rural recovery is actually happening. Some part of it is internal and some part of it is because of the government push. So post-elections, we spoke about the fact that state elections coming through will drive spending from the government. We're seeing the first signs of rural recovery growth coming through, and that's a space I think gives both a defensive positioning as well as an increased rate of change of growth. So here again, this part of the portfolio is not going to generate nonlinear returns, but what it would do is it would protect you against drawdowns because of the fact that you've not seen growth for 5 years. Incrementally, you're seeing growth. This part of the portfolio will also lend itself into a higher ROCE because margins are also expanding. The third theme that we like, that we believe is an interesting theme over the next 3 years is metals. Here again, if you just look at the 4 charts, which I'll just walk you through, pretty much everyone is aware that non-growth fiscal spending in the US is at an all-time high. What that means is what US needs to be spending in order to service its interest debt, right? Now, you've seen Fed cut rates by 50 basis points. Maybe they will do 1 or 2 more cuts going into the elections. But I still think because of the way the world has to spend, both from a manufacturing and a power perspective, inflation is here to stay. So structurally, I think we are going into a higher inflation economy rather than a higher deflation economy, which means I don't think there has to be a floor on interest rates. And with the way the government balance sheet has expanded in the US, this fiscal spending, I think there is a floor to it. Now, what you've also seen, which is shown on the chart on the right, is the global money supply. So this talks about not just the US, but the actual money supply that is coming in, including countries like Japan, China, etc. And that is again on an uptick. Maybe US is not expanding its balance sheet, but today China is taking over. And when money supply increases, that is again an inflation in terms of assets. So this third chart just explains to you when M2 money supply goes up, generally it is inflationary in nature because that is a proxy for CPI as well. All of this effectively means one of the sectors that globally we have underinvested in is metals, because between when I spoke to you about a deflationary economy between 2010 and 2021, one sector alongside power that got affected was metals, right from gold or copper. The new mining capacity never expanded. As a result of which, when you look at the price of metals over that decade, it just went down. Today, what you are seeing is an inflation in some of these price of these metals between, let's say, 21 to 24. But even at these higher prices, capex has still not come through. And if the world has to go into a manufacturing economy, and so specifically with India, a lot of these mines have to be restarted. And hence, there is an incremental potential possibility of metals doing very well. So put all of this together. If you look at our portfolio, you will see this is the complete portfolio of Itus, us being overweight pharma, us being overweight non-lending financials, that includes insurance, that includes AMCs, that includes exchanges, us being overweight auto with more so a two-wheeler bias, and finally, us being overweight consumer staples. We are underweight banks, like I said, and we are also underweight IT. The core structural part of the portfolio remains. What we are constructing in terms of the core portfolio is where am I getting growth and how is that growth translating into an ROE expansion? Within this dynamic, how do I ensure I don't sacrifice liquidity? That's broadly the overall construct of the portfolio. Over the last 2 to 3 quarters, from a risk management perspective, we were talking about not concentrating. Now, as earnings growth are becoming a lot more selective, incremental capital is going to roughly around 8 to 10 companies. So how we are building concentration as we speak is the top 10 weights of the portfolio. Roughly around, let's call it 6 months back, was only around 35%. Today, the top 10 weights is incrementally gone up to almost 46%. And over the next 1 to 2 quarters, I expect the top 10 weights to go up closer to 55%. So concentration is getting built into the top 10 weights basis earnings growth. And that's how you will see the skew in the portfolio. So basis this, I'm going to stop and open up the floor to questions, both at a micro and macro level. We'll be happy to answer any questions from the audience.
Thank you, Naveen, for the wonderful presentation. Investors who have questions can feel free to type your questions in the Q&A box. The identity of investors are protected as the questions are only available to the organizers. Naveen, I have a question here now. How do you see this volatility and how do you think it's going to go forward?
So I think volatility has not yet even started, right? So if you look at it, like I said, 6 months back, if you had heard the narrative, pretty much everyone was convinced that India was the only safe haven market to invest. As a result of which, pretty much everyone was convinced that US would fall, China is uninvestable, and only India will receive capital. Today, if you look at it, US is at an all-time high. India has had, I wouldn't call it volatility, but a little bit of drawdown from the peak. And China, there is an increased intent from the government to ease. I still think China is a very difficult market to invest, but people can trade China. There would be interest on and off in China. So incrementally over the next 4 months, like I said, if I track flow of capital, I don't expect FIIs to come back in a hurry. I don't expect DII inflows to stop either. But over the next 3 to 4 months, there is noise around US elections. We'll have to track that. We'll also have to track going into the September and the December quarter, how the earnings pan out. I do expect earnings not to be structural from here, earnings to be a lot more stock and sector specific from here. As a result of which there could be volatility over the next 3 to 4 months. And when I say volatility, I'm talking about 5 to 7% drawdown on the index. So again, let me define volatility, right? So if 2010 to 2024, let's assume that I'm not expecting anyone to think 5, 7, 10 years. I'm just saying, let's say an investor can think 1 year ahead, right? If I take the rolling 1 year returns of Nifty 50 from 2010 to 2024, the worst drawdown peak to trough we've had is 19%. And that was during COVID. So assume COVID was a one-off. After that, the worst drawdown is 15.5%. 1 year, peak to trough on a rolling 1 year return basis. Today, our LTCG is 12.5%, right? So if I know exactly how to pick a top and I know exactly how to pick a bottom, my additional alpha generation post-tax is 2.5%. So what I tell investors is the amount of time we try and spend understanding what is the top and what is the bottom is actually time wasted. Instead, time is better well spent in terms of positioning portfolios. Where are the sectors of growth and how do you try and ensure that you don't own too much of cash either? So when I say volatility, I'm talking about another 5 to 7% drawdown from here. If I get that, I will get ourselves fully invested. So I don't expect big drawdowns from here. I'm not talking about a 15% drawdown. That's not what I expect. I think over the next 4 months, we might see that, and specifically with respect to India. And if we get that, you would see us get fully deployed. We don't have significant amount of cash. Like I said, most of the cash is coming from clients who have come in on the last 1.5 months. And for new capital that comes in, I will get ourselves, at least the thought process that we have today is to get ourselves fully deployed over the next 3 to 4 months, going into Jan-Feb.
Thank you for it, Naveen. Now, would you think it would be a good phase to build a portfolio in this next 3 to 4 month period?
Again, I think
get opportunities to invest.
I think yes. Like I said, we would be selective and look to get ourselves deployed over the next 3 to 4 months. That's how I think about it today. I think increasingly risk management is going to be a lot more important than just buying any stock, and not sacrificing liquidity is going to be important. So how we going to position portfolios, I don't think is materially going to change versus how we are positioned today. And in terms of what I spoke about, a large cap bias, again, I don't expect us to be banking heavy anytime soon.
Do you see the market for semiconductors and data centers in India? How do you see the opportunities in that space?
I think semiconductors is a extremely complex value chain, right? I mean, if you for people who are interested to study the value chain of semiconductors, you will have to study the history of how we do and the number of times they could have gone bankrupt. It's not an easy industry, primarily because it is a very capex heavy industry. But at the same time, today there is a lot of intent. So our industry, I believe, will evolve around first subcontracting work and then design work. And maybe in 20-30 years time, we could get into silicon and wafer manufacturing, which is the value addition work. Now, if you go back and study how Taiwan evolved or how US evolved in terms of the semiconductor chain, there were a lot of picks and shovels business that you can pick up around it. For example, semiconductor industry requires clean water, it requires clean gas, and it also requires robotics and automation. So in terms of the listed market space, I'm not very sure there is an NVIDIA equivalent anytime soon. But where I think you could see non-linear growth is in the picks and shovels space. Like one of the companies that we own, where we think there could still be material upside, is a company called ABP, which had an entire vertical of revenues from the automation side of semiconductors from the US. In India, that side of the business is still zero as we speak. So we will have to look at proxies as we speak, rather than just looking for an NVIDIA to get created immediately. And also realize that even in the private market space, it's not an easy industry to build value addition, but there are going to be interesting, what I call supply chain equivalents that get created in India from where I sit.
Thank you for this. Currently, the portfolio makeup, we have around 30 plus stocks. Now, how do you see this outlook for the portfolio construct?
So I think the number of stocks will come down. Like some of the starter positions that we have built, you would see some part of them may not be executing as well as we expect. So like I said, what concentration will come? Concentration just will not come from the number of stocks, right? Concentration gets built around how you upsize your investments that are doing well. So what you would see happen as we go into the portfolio is the top 10 weights of the portfolio increase materially. There are select pockets that we continue to be bullish on, where we see the managements also execute better than expected. We would be adding more weights there. Consumer durables, for example, is one such sector. I also spoke about asset management companies. I spoke about pharma. You will see us adding more weights there. Typically, I would like to bring down the number of stocks as well. There was a tail that is built that will compress. The top 10 weights will go up, and that's how concentration will get built. But it would be a material endeavor to try and bring down the number of stocks to under 30 over time.
Thank you. Naveen, what would be your outlook on the healthcare segment? Pharma and healthcare.
So, again, I think from a question perspective, I'll have to break it down into subcomponents, because pharma and healthcare is it has 5 industries under it, right? For example, there is hospitals, there is CDMO, where you do contract development and manufacturing. Then there is the generic side. Then there is the what you call Indian branded generic side. And then there is the diagnostics. So pharma has, and each one of this behave very differently, both from a balance sheet, capital allocation, and pricing power perspective. So if you look at where we are bullish on, or where we have our larger exposures, we like companies who have, for the first time, who have invested in the US, because you're coming out of a 7-year down cycle there, but they also have an Indian branded generics side, which will give them the ROC. So the US part of it will be, it will function like a commodity, but it will give you scale. 7 years you've gone through a down cycle, and today there is a potential possibility of prices actually working out in your favor. But even if that is actually getting cushioned from a portfolio construct perspective from their Indian branded generics. Then you also have players like, for example, an Eris, which is a lot more focused only on the Indian product side, who have grown, who can give you non-linear growth through M&A that you are seeing. Then the third part that we also like where we have exposure is in CDMO. Net in all the three pockets that we own, because of the cash to market cap ratio of these companies being at its all-time high, what I see incrementally happening is increased acquisitions. So the fourth thing that we need to think through is in this kind of a market, people do tend to overpay to acquire, and that's where short-term capital misallocation can happen. So we would want to be consciously monitoring that. So for example, if you look at Eris, post the IPO in 2015, it gave you 0 returns for 6 years. One could say that the IPO valuation was very high. One could also say that they acquired poorly in 18. But from 21 onwards, their acquisitions have actually been ROE accretive. So monitoring these acquisitions in terms of the price that you pay, how you turn around them becomes extremely, extremely important. So I think that's another way to evaluate pharma. But these three segments that I spoke to you about are the places where we have larger exposures.
Thank you, Naveen. Naveen, I have the last question. What would be your outlook on the natural gas segment?
Ajit, sorry, I'm losing you. Can you be a bit louder?
Yeah. Can you give me a view on the natural gas segment, energy and natural gas?
Okay, so I think considering the fact that the view on the natural gas has to come alongside oil. So if oil prices stay in the range, natural gas prices typically will tend to stabilize, because what happened in 21, natural gases prices spiked up a lot. From there, you've only seen stabilization and prices fall. If prices fall even further from here, natural gas will act as an alternate energy source for power production or for fertilizers. These are the two sectors natural gas is currently used. The third sector that you could see a push is in terms of CNG vehicles. All of this means that today, if you look at domestic capacity from the LG2 basin for Reliance, the production is already live, which means imports could go up. Currently, Petronet is the one player which basically gives you pipeline access from the Middle East and Qatar into India. So the capacity utilization should go up there. And domestically, you will see the transmission facility from GAIL also benefit. So from a sectoral perspective, there is an ROE accretion for both these two companies. The one counterbalancing thing is because they are PSUs, the government can force them to do capex in unrelated sectors, and that could hurt them. So you have two factors, the core business, both of them can become ROE accretive. What is the counterbalancing thing for them is in terms of them being a PSU, capital misallocation can happen at any point of time. So managing these two means managing your position size. So while we are bullish, we would never overweight this in a significant way beyond a certain exposure in the portfolio in order to manage the capital allocation risk.
Just thank you for this. Maggie, over to you.
Thanks, Naveen and Ajit, for the interesting updates. The recording of this webinar will be sent out by the end of this month. And apologies for the technical issues that happened. We thank you all for your time, and we wish you all a happy weekend.